You've seen that chart, right? It's everywhere. The one that shows the money supply going up and the stock market soaring right along with it. The story feels so simple. More money from the Fed just pushes stocks higher. But is that what's really going on? Well, today we're going to dig in and investigate if there's any truth to one of the most popular ideas in all of finance. So let's get right to it. Does the M2 money supply, which is, basically all the cash, checking, and savings deposits floating around in the economy, does it really drive stock prices? The theory goes that when the Fed prints money, it has to go somewhere, and a whole lot of it just floods right into the stock market. But is it really that simple? And I gotta admit, at first glance, the visual evidence looks absolutely incredibly convincing. You've probably seen a chart exactly like this one. For decades, you've got M2 money supply and a big stock index, and they're just marching upward together, almost in lockstep. It looks like a perfect relationship, doesn't it? So this claim, it becomes this article of faith for a lot of people. M2 determines stock prices, period. More money equals a higher market. But today, we are going to put that claim right under the microscope. All right, so let's start by taking a much deeper look at that super alluring chart, because it might not be telling us the story we think it is. And right away, here's the big problem. It's kind of like a statistical trick our eyes play on us. The issue with that chart is that both things, the money supply and stock prices, are just trending upward over the long haul for their own totally separate reasons. So this is the crucial point. The illusion is that more M2 money causes higher stock prices, but the reality? Well, stocks go up over time because of things like company earnings, productivity, a little bit of inflation. And M2 goes up because central banks, well, they tend to expand the money supply over time. They share a common upward drift, but that doesn't mean one is pushing the other around. This leads us straight into a classic trap in statistics, something called a spurious correlation, a relationship that looks totally real, but it's actually just a coincidence. The fancy term for this is spurious regression. It's when two completely unrelated things seem to be connected just because they're both moving in the same direction. The classic example is ice cream sales and shark attacks. They both go up in the summer, right? But ice cream doesn't cause shark attacks. The summer heat causes both. It's the same idea here. Okay, so to get to the real truth here, we've got to be a lot more rigorous. We need to statistically remove that shared upward trend, and then ask a much cleaner, much more precise question. Do changes in M2 actually help us predict future returns on stocks? And to do that, we're going to have to break out the heavy-duty stuff, the forensic tools of econometrics, to really see what's going on under the hood. To get to the bottom of this, we're not just guessing, we use some pretty serious tools. One is called a Granger causality test, which is just a fancy way of asking, does knowing about a change in the money supply yesterday give us any real edge in predicting the stock market today? We'll also use other tools that let us measure the size of any effect we find to see if it's a huge wave or just a tiny little ripple. So what did the investigation find? When we run the numbers, the answer is a pretty simple no. A change in the money supply gives us no real power, no predictive edge for what the stock market's going to do in the coming months. That link just isn't there. Now, to be fair, if we really shortened our time frame down to just 1 or 2 months, we do find a tiny, tiny hint of a relationship. But the effect is extremely weak. I mean, it's so weak that it's right on the hairy edge of being statistically meaningless. It is barely a blip on the radar. This chart right here, it shows that tiny effect perfectly. It shows what happens to stock returns after a sudden, unexpected jump in the money supply. As you can see, you get this tiny little bump in returns, but poof, it fades to nothing within a couple of months. It's a temporary nudge, not some powerful, lasting driver. So how much of the market's wild swings can we actually pin on the money supply? Well, the data gives us this stunningly small number, just 1 to 2%. That's it. Let that sink in. This means over 98% of what makes the market go up and down has absolutely nothing to do with M2. Look, at the end of the day, the practical takeaway here is crystal clear. An effect this small, this temporary, you just can't build a reliable investment strategy on that. No way. But hold on. Just when you think the case is closed, the story isn't quite over. Because when we zoom back out and look at the long-run relationship, we find a fascinating and completely unexpected twist. So we have to ask ourselves, okay, so maybe M2 doesn't cause short-term returns, But is there still some kind of real shared trend between them in the long run? Well, the answer is yes, but it's not at all in the way you might think. It turns out they are connected in the long run. The statistical term for this is co-integrated. It's kind of like they're two dogs tied together by a really long leash. They can wander apart for a while, but eventually they get pulled back toward each other. But, and this is a huge but, there's a massive catch in which one does the pulling. So when the two of them drift too far apart from their long-term trend, the models are clear. It's not the stock market that does the work to get back in line. Nope, stocks just keep on doing their own thing. Instead, it's the M2 money supply that actually adjusts to get back in line with the market. This flips the whole theory right on its head. Causality seems to run from the economy to the money supply. And it makes sense when you think about it, right? The Federal Reserve often reacts to economic strength or weakness, which is reflected in the market, not the other way around.
Okay, let's bring all this home. What's the final punchline? What does this whole investigation really mean for us?
So if M2 isn't the king, then what really drives the market? Well, it's the stuff that has always mattered. We're talking about company earnings, how expensive stocks are, overall investor risk appetite, of course, interest rates, and frankly, the market's own momentum. Those are the real forces at play. And all this leaves us with one last, really big question. If the statistical evidence is this clear, why on earth does that simple, misleading chart of M2 in the stock market remain so incredibly popular? It's a fantastic reminder to always, always question the story a chart seems to be telling you.